Welcome to Motor Carriers Insurance Education Foundation in-depth review of coverages addressing the unique operations of the motor carrier. This is part 2 of the government requirements. These webinars are not filed for state CE credit and are learning opportunities only. If you need state CE credits, please check our office and we'll give you information concerning the 12 hours each year the foundation provides to its members. If you have any questions, you can type it into this address, trs@mcief.org, and they'll be answered later by email. We're going to review this session. We're going to pick up a little bit and review what we did in the first section as far as the requirements of the government to register. But the focus we're going to have in this session is now the finance responsibility. We alluded to some of it from the first section, but again, we're going to go into another deep dive on this session here. And so we're going to start looking at the SAFER information that we talked about yesterday. Now, when I talk about SAFER, we're talking about the portal that's there that is information that the insured puts in when they register, and information that the officers who do inspections either on the roadside and or at our insurance locations put in. And you can access this either through going direct, like through the review that we went in session 1 about SAFER itself, or most of you access it through a third party, Central Analysis Bureau or carrier software. We're talking here about the information. What I wanted to point out in this first is the operating status. We touched on this last time, but this is important because one of these stats has to do with have we met the financial responsibility requirement. Again, pointed out of service means the motor carrier has been shut down. This is usually an edict from the government, mainly because they've had a bad crash or a habitual violation of rules. Inactive US DOT number, again, that's because they have not done their biannual update, which requires to be done every 2 years based on the last 2 digits of the DOT number. Second one from the end is the year, even or odd. The last one's the month, with 1 being January, 0 being October, and the months there. Authorized for passengers, property, and hazmat. This is the important one because if they're authorized for passengers, they'll have an MC number and they'll have to have an insurance filing. And this is what we're going to drill down on today, on this section. Not authorized means that they have an MC number, but they cannot use it because they don't have insurance in place. That's 2 areas that we'll focus on here. If you're active, that would be your private carriers and your exempt haulers. And some of those might need to meet financial responsibility, particularly if they are a private carrier hauling exempt commodities, will have to have a endorsement to the policy. And if you're a private carrier hauling things hazardous, you might have to have, your insured might have to have an endorsement to the policy. So going back to the status, and the ones we're going to focus on is you're authorized, and if you're authorized, you'll have a separate MC number and you'll need an insurance filing. Or if you're active and you're a for-hire motor carrier, you'll need an endorsement to your policy. And if you're private and hauling anything hazardous, you'll also need an endorsement to your policy. And again, you'll find out on the website the name and address of the insured, the DOT number. And this, again, the reason I'm showing this up is the DOT number is the first thing. And if they're hauling processed goods of others, then they'll have an MC number also. And that's where you need a filing. We talked about the biannual update. If they don't update on a biannual basis, then they'll be made inactive. And this confirms what we talked about before. Current rated, satisfactory, unsatisfactory. Again, we talk about why unrated. There's no reason for the DOT officer to perform a full compliance. And then the holders of the MC numbers, last time we looked at about 265,000 of those, and there are 63% of those were unrated, and only 11% satisfactory, about 3% conditional, and less than 2.02% unsatisfactory. So the point here is these are done when you have a full compliance review at the insured's location. And in that case, their DOT officers are not doing full compliance review as often as they used to. And now this is this area here. So if you find them unrated, that's not necessarily a bad thing. In fact, in my concern, my position, it would be a positive thing as long as they have been in business for 2 years. Then you need to look at the actual inspection results. The other thing that I'd want to point out is these are people with MC numbers. If we went through the whole body of people with DOT numbers, that's going to be about 500 to 550,000 active people in those motor entities in those addresses, and these numbers would be different. These are MC numbers. These are the core business of the Motor Carriers Insurance Education Foundation. These are for-hire motor carriers hauling processed goods of others in interstate commerce. We also look at the types of units here, the numbers of units. Of these motor carriers with at least one power unit, meaning 258,000, the 20,000 difference are people with motor carrier that show no power units. Why they do that, I don't know. Zero access, or they lease them, all that thing. And there was 560 some odd thousand with brokerage authority, 208,000 of which have active brokerage and transportation authority together. That is a no-no, because those cases are hard to get, because now they haven't separated a separate legal entity. The other point I'm making here is that notice the small number. Again, over 90% of motor carriers with MC numbers have fewer than 20 power units. Of that number, 260,000 have fewer than 5 power units. That's the core of most of your people's business. The small motor carrier who has 1 to 5 trucks. Sometimes we call them mom and pop operations. Those are the ones that are deal with. Those are the ones that are involved in getting loads from brokers and this stuff. Even though the percentage of owned autos are much higher than that. So of the potential people with MC numbers, over 90% will have less than 20 power units. Those are your smaller motor carriers. Just to then focus on the overall body of potential risks that we could write. So now let's talk about the current responsibility. Motor carrier for hire, they obtain a DOT number. That's the information that's in SAFER. That's information that must match up on the applications. That's information we went in through the first session that we did earlier on with the motor carriers and the government. But now they, in addition to the DOT number, if they're hauling processed goods of others, again, the difference we explained is with my father. When he was hauling cucumbers, they're not processed, they're exempt. All he would have to have is a DOT number. But when Vlasic Food opened that plant in Millsboro, Delaware, and that cucumber got cleaned, put in a jar, pickle juice in the jar, lid on the jar, a label on the jar, in a carton coming out the back door, he cannot haul that same cucumber away now that it's been processed and made into a pickle. He will need a different MC number. The MC number says he is licensed. A license is authority, and the C number means he needs insurance, proof of insurance. And this is what we're going to focus on here today, is just financial responsibility and what it really means to everybody. So just to summarize, currently the federal government requires motor carriers to gain from them, meaning permission, authority, a license to haul certain properties, non-owned properties that have been processed while the property is in interstate or foreign commerce. This must be, the permission must be obtained before they can start hauling that property. The motor carriers then provided MC number. They cannot use the MC number until you have proof of financial responsibility. That's a certificate of insurance that we're going to look at that has the number 91X. This protects the public for all activities under the government authority to haul certain types of cargo, again, non-processed goods and interstate commerce that are not owned. The motor carrier with MC number then must have this 91X. That's how the two together. They also need to have a processing agent. We don't pay much attention to that. A lot of people don't understand even what the process agent is. It's a real old concept to even have it, because today with all the technology and the internet and all that, it's easy to find out how to file legal papers. But the process agent early on recognized that our motor carrier is interstate, meaning they travel in many states, and they could have a crash and do damage in a state that they're not domiciled in, and the citizens they hurt in that state need the ability to have legal papers started, court cases started by dealing with just people in that state. And so what a motor carrier has to do is anoint somebody, appoint somebody, register somebody who has permission on their behalf to receive summons, complaints, paperwork, dealing in the court cases with someone in that state that the injured party's in. And that's what a processing agent is. It's a simple thing to do. There's a half a dozen of them out there. It's relatively inexpensive, but it's something that a lot of times they're ignored. The reason I point this out, I've had classes in our face-to-face where they said, our insured got a new DOT number. They've got an MC number. We filed insurance, but they're not authorized yet. And that's because they did not choose the processing agent yet. That's the third step, DOT number, MC number, and then processing agent. So they now have authority to haul processed goods of others in interstate commerce. We went into the FMCSA website and downloaded the information that needed to be done as far as the insurance requirements. This is a BMC 91 or BMC 91X. Don't get hung up on that. The big difference is 91X allows it to be layered where the 91 does not. Today, marketplace, everybody's using the BMC 91 or should be using the BMC 91, not the older BMC 90. Excuse me, they should be using the BMC 91X, not the older BMC 91. This came in place when the Motor Carriers Act of 80, when the limits were moved from 300,000 to 500, and eventually 750,000, plus they introduced the hazmat requirements of $1 million or $5 million. That was put in the marketplace, and this allows it to be layered. But notice who has the head. If you're hauling general freight, that's 750,000. You could have up to needing a $5 million depending on the commodities, meaning hazardous or not. A lot of people don't understand those are people who are hauling vehicles 10,000 GVW or larger. There is a requirement for 300,000 if it's non-hazard with vehicles less than 10,000 GVW or larger. This is your expediters. This is your couriers. This is your last mile delivery where you have a lot of risks now. They're crossing state lines, hauling property in interstate commerce and vehicles less than 10,000 GVW or larger. The anomaly here is that vehicle is not required to have a DOT number, but is required to have an MC number and $300,000 worth of coverages. If you're a passenger hauler, then depends on the number of seats in it. If you have more than 15 seats, you're required $5 million. If you have less than 15 seats, or 15 seats or less, then you're required to have $1.5 million. So this is the requirements here. The one that we focused on, obviously, is the freight haulers, which will be determined between 750 to 5 million, depending on if the items are hazardous or not. The BMC 34, this is a cargo filing. This changed in March 2011, where all common carriers had to have a cargo filing. Now the only people that had to have cargo filing are household goods. They're the only entities that have to have cargo filing. So if your insured has an ability, authority to haul household goods, then you have to make a cargo filing. Cargo filings are very similar later to MCS 90s. What they do is they pay up to the $5,000 per vehicle, $10,000 per occurrence to satisfy the customer if the insurer does not take care of these small items that are damaged during the movement of household goods. The BMC 84 and BMC 85, those are people who have freight forward authority and or brokerage authority. This is the area where it's a surety bond, and what that bond does, it says it doesn't do anything but protect the motor carrier who got the load from the broker or the freight forwarder, and the broker or the freight forwarder does not pay the motor carrier. This is a payment bond. This is where if your insured accepts a load from a broker or a freight forwarder, they complete that load, complete the paperwork, send that paperwork in, and then the broker or the freight forwarder does not then pay them for that hauling of that load. Then they can make a claim against the surety, against the 750,000 to get that money paid. It doesn't benefit anybody except two people. It benefits the motor carrier who did not get paid. It also benefits the shipper who used the broker or freight forwarder, because before the shipper could in fact be liable for having to pay twice because they really owe the trucker who hauled the load that fees. not, even though the broker has been paid and the broker hasn't done it. So this is the advantage you have here. We already talked about the BNC03 being the processing agent, all authority. Notice you have this underlined so you can click on that and find out more information concerning the processing agents. The other one is the MCS 90. This is the endorsement to the policy that meets the Motor Carriers Act of 1980 requirements. So this is the overall financial responsibility. Again, you can find this at the website. The 3 elements you have here is, in addition to the MC number, a DOT number, you have an MC number, then you'll have to have a 91X filing. If your insurance involving household goods, then they need a cargo filing. If you have a broker, then they will need the broker's bond, and you also would need the processing agent if you have an MC number, and you might need, and you will need it if you have MC number, a endorsement to your policy, or if you're an active, meaning you're exempt hauler, either for hire or private, you will need an DOT endorsement to your policy, MCS 90, if you're a for hire interstate for an exempt hauler, and if you're a private carrier hauling anything hazardous. We'll drill down here, but this is what you can find at the federal website to tell you what's needed. So the federal requirement requires the 91X. Property being hauled is processed. It's pickles, not cucumbers. They obtain the MC number, additional DOT number. Raw material made in consumer goods. This is what requires the certificate of insurance. The 91X, the certificate of insurance sent to FMCSA. It is a filing. That's called the 91X. It's not insurance. It's only there to protect the public. It only becomes involved in a crash if no coverage in the policy. Then the insurance carrier that makes the 91X filing would have to protect the public for any damage claims caused by any unit the motor carrier uses as part of their business as a motor carrier using that authority granted by the government. That's the key part here. It only comes involved when there's no coverage. It's there to protect the public. It does not provide any protection to the insured. This is the BMC 91X. This is the coming again. You can download this off of the federal website. This is where you set the what is the certified here is that the name of the insurance company. That's the insurance carrier. That's the insurance carrier. Insurance company's name, and you also have the ability to layer. That's what the X is. This is where you have the up to 750. Then you can do X7. Then you can put 250 X of 750, or if it's a hazmat, you would have the first million. Then you would have 4X of 1 on the layer part. But this is the important part here. The two part here is the name of the motor carrier must match the name and license insurance. And second, that requirement here, the limits required must meet the requirements set by the government. Then this is the part of it that causes a problem. The receipt of this certificate by the FMCSA, meaning certificate of insurance, certifies that a policy or policies of public liability, and later we're going to talk about that because public liability is defined in the MCS 90, not defined in our policy, and we'll talk about how that find that out. For auto liability and physical damage and property liability, insurance has been issued by the company identified in the face of the form. That company is qualified. That's the first important word here, is qualified. To be qualified to make a filing, your insurance carrier must be an admitted carrier in some state. Not necessarily the state that the vehicle is licensed in and domiciled in, because there are a number of states, 3 of the largest ones, Texas, California being the 2 biggest ones, and then in the cases of Louisiana and others, that you can write primary auto insurance not admitted. But in those cases, you would have, the insurance carrier would be admitted in some other state. Who determines if you write primary auto insurance not admitted is the Department of Motor Vehicles, what they accept as proof of financial responsibility. How you write it not admitted is through the Department of Insurance. If you have any discussion here, look at our in-depth study with admitted and not admitted insurance carrier or insurance policies. That's later here. But that's the key part here. The second key part is reading on down the line in this part of it here, the next line down, is that there's an attachment of endorsement. That's the BMC, the MCS 90 is the policy or similar form to the policy who issued that. So anytime an insurance carrier makes a 91X filing, they must put an MCS 90 endorsement on the policy. That's the big key here. So that's the point here. You have to be qualified and you have to have an MCS 90 attached to the policy. So after we find out you have to be qualified to be a admitted carrier, and MCS 90 is an endorsement that has to be attached to the policy. Let's look at the bottom part of that first paragraph. 4 lines up says, regardless of whether or not such motor carriers' vehicles are specifically described in the policy or not. What that means is you still have to protect the public insurance carrier whether that vehicle is a covered auto or not in the policy, because then it goes on and says the liability of the insurance company extends to all losses and damage, injuries, or death occurring within the authority granted by the insured, granted to the insured by the FMCSA or elsewhere. So that's what that says is that insurance carrier who makes a 91X filing must protect the public whether the vehicle the insured is using or not qualifies as a covered auto in the policy. This is where later we're going to drill down why we have to insure all vehicles 10,000 GVW or larger on our policies so that we get premium for this exposure and don't have to rely on protecting the public. And if the vehicle is a covered auto, this does not become important. The next paragraph, though, is also important, and that's kind of misunderstood. And this is where insurance companies have some different approach to it. This endorsement described here and may not be canceled or withdrawn without 30 days written notice. This is a continuous certificate. It does not have an expiration date like your policies have. So the question that you have to have each year by an insurance carrier, and they differ, is that do we cancel the policy? Do we cancel the filing at renewal time? Some carriers do, some carriers do not. And this is a question that you would have to ask your insurance provider, because this is important. We're talking about renewal. We're talking about the insurance carrier has been on this risk for the period of time, in this case, probably somewhere around 10 months. And in those cases that the carrier has the opportunity now to decide, are we going to renew it or not? Now, that's the first thing to do on the policies. Some states even require notice if they're not going to renew. Those notices sometimes become 60 days. And also if there's increased premium. Those that have nothing to do with there, you have to meet the state requirements to notify if you intend to renew or not, or you intend to raise the premium. So if you're going to renew, if you're not going to renew or raise the premium significantly, then you need to cancel the 91X filing. But if you want to renew, now your question is, if I send a 91X filing and we cancel that, that's going to interrupt my relationship with my insured. Because if we want to keep them, the only thing that we have in place, meaning the current insurance carrier has in place, is the ability to operate, and that is the filings there. So this is the dilemma every insurance company makes. Some insurance companies cancel the filing each year, some do not. As an agent, you need to be aware of that possibility and learn and find out from every carrier their approach to it. My suggestion is, from an insurance carrier standpoint, if you get information from the retail agent, they're dealing with the insured, you're getting updated and renewal information for them. Hopefully that will be starting somewhere around 45 days out. Then you might not want to cancel the filing if you intend and want to keep the renewal. What people don't understand here is that how this works. The filing can be canceled 2 ways. The insurance carrier can send a notice out and cancel it, or if another filing is made in the same name and same address as the current filing, then the current filing is canceled by replacement. And so the situations that we have is your insured is been with you for 10 months. Your insurance carrier decides not to cancel the filing because they want to keep the renewal, and your insurer decides to not accept the quotation of the incumbent carrier but chooses another carrier. And so now we have a crash that happens when your insurance carrier has their filing still in place, but they have now coverage with another insurance carrier. The question that I ask a lot of retail agents and the underwriters and companies who are on the face-to-face is, then what policy would have to respond? The one with the filing or the one that has been bound with the new coverage when the old policy expired? Unfortunately, a lot of people say the filing. No, the filing does not have to respond. The filing does not respond. What responds is the coverage that's in place, and that would be the new policy. And as long as there's new coverage in place, that new policy would respond and would pay. And they would pay, and as long as they pay the minimum limits, the filing obligation is met. So the filing would have no exposure unless your insurer decides not to renew. And that's where the exposure would be. So this is a point here, and this is a point of renewal, a point of handling this this way, because there's also another thing that people don't understand concerning the filing and the cancellation of the filing. A lot of your shipper and brokers hire a third party, like we use Central Analysis Bureau or carrier software to aggregate information on the federal website. A lot of them use like Carrier 411. Any of these third-party providers to the shippers and motor carriers track when a filing is being canceled. And the filing is being canceled, then they notify their clients, meaning the shippers and the brokers, that this motor carrier's filing is being canceled, therefore you might not want to use them. Even though you intend to renew, you intend to make the filing again later once they pay your premium, you now have potentially interrupt their bills with their customers, which again does not sit well with our motor carriers. So as an insurance provider, you need to look at this. There is some blogs on our website that talks about this cancellation that I suggest you look at, but this is what you need to focus on when you consider about how to handle the filing at renewal time. So 91 certificate insurance, it's not insurance. The name on the certificate of insurance is reflected as the motor carrier is the name the motor carrier has told the government they are, and that's reflected in the federal website, license and insurance. Note, this is to complete the process of being legal. The insured in the policy issued to the motor carrier is the owner of the assets exposed to loss, not necessarily the name the government knows them by. So you want to coordinate those two items here to find out if it's just legal or the assets. So sometimes those names could be different. The limit must be the limit required by the government, not limit on the policy. It's not required. A lot of carriers put the limit on the policy, but that's not required. All that's required in 91 is the limit that the government requires. This is based again on the 150 information where the motor carrier tells the government what they're hauling. Somebody interprets that to find out if they need more than the 750. The policy certificate insurance is based on must have an MCIEF 90 endorsement to the policy. We're going to talk about that. That's the second financial responsibility requirement. We'll talk about that in a few minutes. But again, the bottom line here is both the 91X that we're talking about here and later MCIEF 90 only protects the public. It protects the public whether the unit being operated under the motor carrier's authority is specifically described in the policy or not. And it only comes in when there is no coverage. So the continuous proof of financial responsibility to protect the motor carrier until canceled either by the insurance company or replacement. This is what we went through here, and this is where you would think that replacement. Our marketplace, where most of us are dealing with insurance carriers who specialize in this area, those insurance carriers who buy new coverage send the certificate out immediately, and so therefore the old certificate will be canceled by replacement when the new policy becomes effective. And so this is another reason why you want to look carefully about the policy of canceling the filings each year if you want to retain the business, because not only if they got new coverage in place, then that new policy would come, but even with new coverage in place, and that new coverage is with someone who specializes in writing trucking insurance, which most of the market would, then that new company will make a filing immediately, and now your old filing will be canceled by replacement. The 91 becomes involved in a crash when there is no coverage. If coverage, the public still is protected by the insurance carrier payment of the judgment against the insured. So the 91X does not come into place here. But the insurance carrier could seek reimbursement. This is the key if there's no coverage. This is a surety bond. We'll talk more about this when we look at the MCIEF 90. To keep the authority active, they must have a 91X. which continues until canceled. So if they're not authorized anymore, that's because they do not have a filing in place. If canceled, the authority then is revoked, and that's what, if the filing is canceled, the policy is revoked, and that then interrupts their ability to deal with the shippers. MCIEF 90, it's an endorsement. It's not sent anywhere. It's an endorsement of the motor carrier's insurance policy to meet the financial responsibility requirements imposed by the Motor Carriers Act of 80. If your insured also has a MC number beyond the DOT number, then that filing sent to the government says that MCIEF 90, like we just went through, there's MCIEF 90 attached to the policy that filing is based on. Again, that's not insurance. It's only there to protect the public. It does not protect the insured. If coverage, then the certificate of insurance and endorsements are not involved in the claim. That's a very important part here. A lot of people get all upset about these endorsements and these coverages and all, but they only come in place when there is no coverage in the policy. The MCIEF 90 continue. Cancellation provision, the insurance provider wants to cancel the policy midterm that the MCIEF 90 is attached to before the policy expires. Why would the insurance carrier want to cancel the policy midterm? Now, the reason we're talking about policy here is that the endorsement is attached to the policy, so the management of the endorsement usually falls on the same management of the policy. And we're talking about now, not continuous, since that endorsement is attached to the policy, then it expires when the policy expires. So now we're not talking about the renewal, we're talking about the term of the policy that's in force. And so they want to cancel it midterm. Why would the insurance carrier want to cancel the policy? Typically for two reasons: non-payment or material change in exposure. And even for non-payment or material change in exposure, we cannot get off it immediately. We have to send the insurance carrier, the insured, 36 days notice of canceling the endorsement / the policy. So first lesson you learn in this business is don't be the bank of the motor carrier, because if you have a policy with MCIEF 90 attached or 91X filing in place, you need to get upfront money, at least 25% down in good funds before you bind the coverage. Because once you bind the coverage and put the MCIEF 90 as a part of that binder, you now cannot cancel that binder without giving the motor carrier 36 days notice or giving the federal government, if they have a 91X, notice the cancellation of that part of it. This is the key part here. Even for non-payment. Why would the insured want to cancel it? That would be mid-pay and they got a better premium. In this case, again, this is a bilateral. The insured would have to give us 36 days notice that they intend to cancel the policy. So if you ever have an opportunity where you have you're quoting a risk, you have a better plan for the risk, and you want to make your policy effective midterm, realize that that current carrier is not going to honor your policy release. You honor the insured's request to cancel the policy immediately. They're going, in most cases, not cancel it 36 days after the insured requests that cancellation. So when you deal in something like this, you need to inform the insured that we're going to make our coverage effective 36 days from now, so that you can give the current carrier proper time to meet their requirement by the government. Again, always blame the government. Requirement of government because of the notice requirement here. A key part, this is a key consideration here when the policy is being canceled, either for non-payment or at the insured's request. Both parties need to give each other 36 days notice. The law, this is Motor Carriers Act of 1980. This is what generated MCIEF 90. It's major change in regulation from the motor carrier. The big part here is the previous requirements for an MC number was very specific. It was very limited. Like my father, when he got the authority to haul the pickles from Millsboro, Delaware, his authority didn't say pickles. It said food goods, but it also limited all territory from the southeast territory. So he could only haul food goods, and he only could haul in that territory. If he wanted to haul other goods than food goods, manufactured products, If he wanted to go beyond his territory, he'd have to use someone else's authority, either through a trip lease or an interline agreement, to allow him to haul more than what the government hauls. This is what happened prior to 1980. When 1980 came in place, all that went away. The Motor Carrier Act of 1980 said that now you can haul general commodities under irregular routes. So now you can haul anything, even low-grade hazardous, anywhere you want to for $300. So this is where the exclusivity came away, and this is what it meant. It opened up competition. When my father got his authority in 1975, there was about 17,000 people with MC numbers. If you go back to the earlier slide we had, today there's over 260,000 people with MC numbers. Granted, it's been a long time since 1980, but by the same token, that's a lot of new people out here to foster competition between the parties. It also raised the increased limits from 300,000 to 750,000 for basic non-hazardous goods, and if it's hazardous, this is when they introduced the $1 million and $5 million for the hazardous material here. They also went from the 91 to the 91X so it could be layered. And they also promulgated the endorsement to the policy that would be required for anybody who needs to meet the minimum financial responsibility limits imposed by the Motor Carriers Act of 80. And this MCS 90 endorsement adds another factor to the 91X. It also still incorporates where the vehicle specifically described in the policy or not would be a concern, but also now it addresses the pollution, the environmental cleanup, the pollution coverage. So the MCS 90 not only reconfirms the vehicle, to protect the public for any vehicle the insured uses, it raises the limits, it allows it to have a 91X layer, but it also now introduces the pollution coverage. Pollution coverage as defined because of the cleanup by the endorsement, and also the limits now with $1 million and $5 million. So this is what the MCS, the Motor Carriers Act of 1980 did as far as financial responsibility requirements. Here, who has to apply? This is 387.3. This subpart applies to for-hire motor carriers operating motor vehicles transporting property interstate or foreign commerce. Two parts here. The first part is of a motor carrier. If a motor carrier is hauling processed goods, then they will have the certificate insurance. And that certificate insurance would also mandate the MCS 90 endorsement. But if you're an exempt hauler, for example, if you're my father hauling cucumbers, then he would not need a 91X. All he would need a DOT number. But since cucumbers are property, he would need this endorsement, MCS 90 attached to the policy, the ability to meet the minimum financial requirements imposed by the Motor Carriers Act of 80. That's pretty simple here. Those are people interstate. But the one area that sometimes we overlook is the second part of this. It's not where the truck goes. The transporting the hazardous material, or excuse me, transporting the property. If the truck crosses state lines, then we understand that, and they will need a DOT number. But you have a lot of places that we can look at where your trucker hauls interstate property without ever crossing state lines. Think piggybacks at the railroad. Think intermodal from water. Think interline agreements with other insurance carriers who are doing the local delivery. This is where the property is coming from another state. And even though your insured never leaves the state, they also must have an MCS 90 attached to their policy because they're hauling interstate property, even though their truck is intrastate. This is something that's overlooked often in this area and that you need to be aware of. That is the limit that require your motor carrier to have 750, again, only for hire. This subpart applies now on the second part B to motor carriers. Now this includes private as well as for hire. Operating motor vehicles transporting hazardous material, hazardous substance, hazardous waste in interstate, foreign, or intrastate commerce. This is any motor carrier, private or for hire, hauling anything hazardous anywhere. And so this is the first requirement. Now we're going to carve this out in a second. And if my motor carrier is in the first category, they require 750 if they're for hire. If the for hire is in the second category, now they require $1 million or $5 million. If I'm a private carrier, I do not have to meet any federal requirement until I do haul something hazardous. And then when I do that, then I must meet this financial responsibility requirement. So the important part here is that all motor carriers for hire, interstate commerce, hauling property in interstate commerce must meet the minimum financial responsibility requirements of the Motor Carriers Act of 80, and that requires the MCS 90 endorsement. If I'm hauling anything hazardous, then I would need to increase that limit if I'm for hire from 750 to $1 million. If I'm a private carrier, I don't have to worry about minimum financial responsibility requirements until I'm hauling something hazardous. Then I become involved in this, and now I will have to have $1 million or $5 million. The only two exceptions you have to deal here is the size of the unit and the commodities you're hauling. The rule in this subpart does not apply to motor vehicles with a gross vehicle weight of less than 10,001 pounds. This is where we get this. We have to insure all vehicles 10,001 GVW or larger. Where we get this is the actual mirror image of this, because if they're less than 10,000 GVW, we won't have to worry about it. But if they're more than 10,000 pounds GVW, then we'll have to worry about it. That's who we have to protect the public against. So this is where we get 10,000 GVW. The second part of this is the kind of dumbest part. This except does not apply if the vehicle is used to transport any quantity of material. This exception does not apply, again, if they're hauling any quantity of material here that's hazardous in the material in this part of it. And that's where if the vehicle is even less than 10,000 GVW, they would have to also still have the meet this requirement. For example, I had an insured or had a customer who, a client that I get consulting work, who had a quarry hauling dynamite in pickup trucks. Then they would have to meet this requirement because of it being a dynamite. That's what these other commodities are. The second exception that we have here is that the vehicle, if it's in interstate commerce and you haul any quantity across state lines, then you would have to have the MCS 90 if you're a private carrier on your policy. If you are intrastate, you would not have to have it until you have hauling in bulk, either 10,000 pounds 10,000 pounds of a solid or 3,500 gallons of a liquid. So it also depends if you cross state lines or not. Cross state lines or not, you have any quantity. If you do not cross state lines, then you would have to be hauled in bulk before you're required to meet this requirement here. So the only two exceptions that you have here is the 10,000 GVW, and the only two anomalies is do you cross state lines or not. Any quantity, if 1 can of paint, if you cross state lines. If you never cross state lines, it applies to intrastate only in bulk. So the MCS 90, protection of the public. Negligence in the use of autos that are subject to the Motor Carriers Act of 80, that's 10,000 GVW or larger. The endorsement would require the insurance carrier to respond to public liability on a blanket basis. Public liability includes bodily injury, property damage, and environmental restoration for all autos owned or operated by the insured after determining there's no coverage. Again, the coverage comes first. However, anytime we have to pay, our insurance company has a right to subrogate, right to recover, because this endorsement also adds, however, endorsement does not provide protection to the insured. The insured must buy policies to protect themselves or could have to repay the insurance company. And so in this case, the reimbursement part of it here, we have to watch two things. What's a covered auto? Meaning, are we covering all vehicles insurers operate, all part of their motor carrier business? Those would be owned vehicles and as well as owner-operator vehicles, lease vehicles. That would be, you would need specified, every vehicle specified on the policy and or any auto and or hired auto to cover those exposures. You also need to find out about, do they have pollution coverage? And that's a separate thing. I refer you to the in-depth study concerning pollution that you also can access in those areas. But that would be typically adding the MCS 90 endorsement to the policy, or some other insurance carriers have their proprietary endorsement. You also need to remember that anytime you put MCS 90 in the policy, then you're going to promise to give 36 days notice to cancellation. This tells you to get the 25% of the policies up front. So to make sure you have coverage, you never want to have no coverage involved. You never want to have an MCS 90 and 91X become involved in a crash. You want to have the policy respond and have coverage. At that point, then you have the full $1 million worth of coverage. You don't have to worry about any conflicts between your insured having to pay reimbursement or not. And the way you do that is to make sure that you have any vehicle insured uses symbols 10,000 GW or larger, then that's no problem. The problem is if you have specified the auto is not listed but still used. Those would be the owned vehicles or the hired owner operators. If you add hired auto coverage to specified, then you're taking care of the owner operators. And so we talk about symbols, and again, you can refer to the coverage in depth series concerning symbols to give you more information concerning this part of it. The second part is you have to worry about the insurance carrier providing pollution coverage. The standard way to do it, CA 9948, that's the standard ISO buyback. Sometimes they're included within the policies automatically by a lot of insurance carriers because they know that they have to respond to this. And since they know it's a known exposure, they know that they're not be able to seek reimbursement easily. So therefore, they automatically include it as a plus to hope that the agents use it as a self. Sometimes they'll do it at an additional cost, like assign risk and all, to add it to it. But don't forget, you have the reimbursement possibility, so you want to offer and provide the coverage of make sure all the vehicles that are the insured uses are going to be considered a covered auto, and make sure you have pollution coverage in the policy so the insured is not exposed to having a crash happen, no coverage. Again, they only come in place when there's no coverage. The insurance company addresses that crash. Once a judgment is rendered and they pay that judgment, now they can seek reimbursement from your insured. The first time they do that, they're going to call you up and say, why am I getting this reimbursement provision here? I thought this gave me coverage. It does not give you coverage. Never talk about any of this stuff with coverage. If you talk about coverage, then you hear an underwriter or claims person talk about coverage, then you know they don't understand this process. This process is only to protect the public when there is no coverage. It never provides coverage to the insured. It just protects the public. These are the limits of coverage you have. The basic limit, 750. The 5 million, that is the vehicle 10,000 GVA or larger. That's the higher hazmat. That's the real hot stuff. Your insureds don't inadvertently pick up things needing 5 million because the shipper is the responsible party as far as FMCSA required, the EPA required. So if the shipper allows a motor carrier to haul a load that requires 5 million, and that motor carrier does not have the 5 million and properly vented their driver, then the shipper can be responsible. So in the cases of your insurance hauling items that need 5 million, then you would then the shipper would drive that, and you would know they have to. And this is where you would either, as an insurance provider, you could write the 5 million under the MCS 90, or in a lot of cases we write a basic million and then have 4x of 1 to meet this requirement. This is where the 91X comes in place. The item 3 is $1 million. This is if you haul any quantity, notice across state lines, and then if it's in bulk, if it's not in state lines. This is what we quoted earlier in this. And this is where there's a lot of motor carriers out there who need $1 million who do not show it here because they don't understand this part of it. And the way they determine what needs to be done from a start standpoint is what they tell the government hauling. For example, my son-in-law is in South Carolina. My son-in-law is an exempt hauler, is a private carrier, and he got stopped for not having the DOT number. And so when he filled out his application, he said that he uses this F-150 or F-500 Ford, which has a GVW about 18,000 pounds, to haul building material. And I know that that would only require 750. However, I do know that he has a skid loader. That skid loader can be put on a trailer attached to this F-500 Ford, and every now and then, about once or twice a month, he takes that skid loader either to Georgia or North Carolina, because his property is sitting right at the northwest corner of South Carolina, across state lines. When that happens, then he needs $1 million. But he didn't lie about it because he didn't think about that occasion. So a lot of your insureds are going to an inspection time. So if the DOT officer ever came in and inspected him, they're going to find that 750 is not enough because they see the skid loader, they see the trailer on the inspection, so therefore they know they would need $1 million in those cases. The $5 million is the ones on the bottom where your insureds are hauling the dynamite, poisonous gas in vehicles less than 10,000 GVW that we talked about before. So basic motor carrier needs 750. That's a for-hire, interstate commerce, non-hazardous good. They might need 5 million, but the shipper's going to determine that part of it. They probably need, a lot of them need $1 million, but they don't have it here until they get it inspected. And this is when they haul private or for hire would need this $1 million. And if you haul any quantity, you would do this, or if you haul across state lines, interstate commerce, or if you haul it in bulk, if you're intrastate. And then the rare cases where you have a pickup truck hauling poisonous gas or Class A or B explosives, which will all into the 5 million in vehicles less than 10,000 GVW. There's a famous court case that every insurance carrier you need to deal with and every attorney need to deal with that spells this out. This overturned a lot of bad law. It was a court case with the Fifth Circuit, which is in Denver, in 2009. The title of this case is Carolina Casualty versus Yates. Now, first off, it's a mixed operation. It's a farm operation with vehicles on a farm, but they had two 18-wheelers. They hauled their own good. They also had this in the farm vehicles and the 18-wheelers with the same legal entity, both of which we recommend not to do, but this situation had. The farm had the vehicles covered for $750,000, have no idea what's on the $750,000. Some of those were over 10,000 GVW, but they were not the 18-wheelers. They covered the vehicles that the farm used. The two 18-wheelers were within Carolina Insurance Company. They had $1 million MCS 90. All units were owned by the same legal entity, and some used in the farm operation, larger ones, 10,000 GVW, plus the tractor trailers that were insured by Carolina Casualty. A crash happened, a lot of damage, bad damage, more than the 750. State Farm paid the 750, but the plaintiffs wanted more, so they attempted to bring the Carolina Casualties MCS 90 into the case. So the court ended up ruling. Now, it went through two processes here, three layers of discussion. The first layer was the trial court said MCS 90 would have to respond. The appellate court on the 10th Circuit said they had to respond, but now they impaneled the whole 10th Circuit. And what they said here, and the reason they came in, is the financial responsibility requirement is protect the public. So as long as the public was protected, 750 paid, no matter who pays it, the MCS 90 and 91X obligation is to protect the public is met. So the MCS 91 only becomes involved when there is no coverage. This goes back again at the renewal. If the insurance carrier buys a new policy and that new policy is in force, even though your filing is still existing, that new policy will respond. And as long as that new policy pays at least the 750 is required, then your filing does not become a part of the case. Your filing does not have to respond. And so this is where this comes in place. Major ruling. This is the law of the land. It still held up since 2009. So this is the cornerstone of how we handle currently and going back to the renewal, and also later when you talk about coverage, this is where you can have your own operator to have some of their own primary coverage still operate under the insured's MC number. That's a different subject. When we get with symbols, we'll talk about that. There's also some discussions and communication with your retail agents, because a lot of times you as a retail agent with your insurance, your retail agent says, why do I only have 750 responsible when I need more than this? So the limits here, the 91X MCS 90 limits are set by the federal government, 750, $1 million, $5 million. The limits are set what motor carrier tells the DOT they haul, we'll talk about before. The limit requirements reflected in license insurance on the federal website. Why reflect more of the limits on the 91 MCS 90 than is required, even if the policy has higher limits? That's because this again is only a B limit, and you want to limit your exposure because it only comes in place with no coverage. So the insurance carriers typically will put what the limit required is on the MCS 90 or 91X filing, not what the policy limits have, because that only comes in place when we protect the public. And so the insurers don't understand it's two processes. The first process of the policy is protect their assets. They get the full limit available here when there's coverage. The second provision is 91X MCIEF 90, which is this there to protect the public. And if all we have to protect the public for is the 750, that's all that we should show on that endorsement or that filing. So the limit of insurance provided to the federal government from the 91X reflecting MCIEF 90 endorsement are what is required, not what's on the policy. So agents need to understand it's our practice, meaning from the insurance company, to only provide proof of coverage to comply with the minimum limits required by the federal government. Please be advised that the insurance policy could have higher limits of insurance. The full limits of the policy is available to your insured for any accident covered under the policy issued by us. The limit furnished to the governments do not limit or change any coverage provided under the policy reflected to your insured, meaning they get benefit of the full limit when they have coverage. It only comes in place when they don't have coverage. To the insured, this is where you want to pay. It is the practice of your insurance carrier to file proof of insurance on behalf of you to the federal or state government at the limits required by them. This gets you legal and ensures your authority is active. The limit reflected on your policy is for protection, and it's the full limit will be available to you for any accident covered under your policy, meaning explain to them that the two processes, one to be legal and one to meet the requirement to protect their assets. And then sometimes this needs to be sent to the customer. Please be advised that the insured name has a insurance policy issued by the insurance company, reflective date with limits of $1 million, whatever it is. All accidents covered under this policy for the full limit of the policy are available. However, it is our practice to only provide proof of insurance to comply with the minimum limits requested by the federal government. Therefore, the information contained in licensed insurance reflects only the minimum limits required to be kept our hauler authorized active. So that's trying to separate those. So sometimes this comes in and you need to explain this part of it here. So summarize MCIEF 90. It's required by both exempt and non-exempt for-hire motor carriers operating in interstate commerce and private interstate carriers of any hazardous material or intrastate if it's in bulk. The 91X filing with MCIEF 90 pledges compliance with the Motor Carriers Act of 80, which means that there's MCIEF 90 attached to the policy. When there's MCIEF 90 attached to the policy, the insurer agrees to pay to protect the public, even if there's no coverage in the policy. But by doing so, they retain the reimbursement back from the insured for any payment they made beyond the coverage. This is the key part here. The MCIEF 90 surership is not coverage. Never talk about its coverage. Surership means that somebody vouches for your insured's financial responsibility. It's like the $75,000 brokerage bond. It's like any performance bond, any bid bond, if you're all involved in construction, which says we vouch for your financial responsibility. If we ever have to pay, we're going to get reimbursement for here. Coverage means it's an indemnification contract when the insurance company agrees to indemnify the insured for payment of the premium. And so all that they're required to have in coverage is the premium paid. It's only to protect the public, it's not the insured. It applies to the insured. It doesn't apply to another motor carrier. It doesn't apply to a broker. It doesn't apply to a driver, just to the insured, no other. And it does not address punitive damage. There's no duty to defend in MCIEF 90. There could be in coverage, but there's no duty to defend in MCIEF 90. So once coverage is denied, then you cannot act in bad faith, and then there'll be no defense. So the only reason the insurance carrier would defend under MCIEF 90 once coverage coverage is properly denied and effectively denied is to mitigate their own payment, meaning we don't owe that much. Our insured was not negligence, contributory, comparative negligence, those kind of things. You're going to have claim for reimbursement. I encourage that, particularly if the insured did not use vehicles. So therefore, the insurance carrier will make the claim to seek reimbursement or not here. And again, remember the 36-day cancellation notice to get you 25% up front. So who must comply? Again, all for-hire motor carriers, the MC numbers must have a 91X, because it says it's attached to the policy. For-hire interstate motor carriers, then exempt only, will have to have the endorsement. Others, if hauling hazardous material, private as well as for hire, all those. Intra or foreign commerce, any quantity, that's when the vehicle, the hazardous property crosses state lines. Intra only, bulk, that must be in bulk. And typically that's 1,000 pounds of a solid or 3,500 gallons of a liquid. If no MCS 90, there could be a possible fine of $11,000 a day. That's the owners of the unit. The only time this is going to become in place is when you have an on-site inspection verification. So the concern you have here is this is when you might find the limits need to be increased, and therefore the officer says you need higher limits, and they expect while they're being inspected there to have that match. The coverage concern you want to do is watch the coverage provided and watch the symbols you use, and do you have the pollution buyback CA 9948 endorsement. Private carriers have no requirement to meet financial responsibility beyond the state requirement. If the state requirements are met, they can operate in all states except if the private carrier hauls anything hazardous in interstate commerce, then they must have the MCS 90 attached to the policy. So the only time a private carrier gets involved in this is when they're hauling hazardous material, and then that would be involved. Other than that, they do not have. So like we talked about in the first section, Florida, you only have 300,000. I'm private. I can go anywhere. I'm building metal shelving. I can go anywhere in the U.S. for 300,000 as long as I'm hauling my own shelving. However, if I started including a can of touch of paint with my shelving, now I have to have the $1 million. For hire, exempt haulers must have state financial responsibility, but not required currently for a filing. And that's the part here. They would need MCS 90 if they're interstate hauling anything that's interstate commerce, would not have to have a filing. They would have the MCS 90 attached to the policy. If the for hire has processed goods, then they get the MCS number. Now you have the 91 filing. Now you have the MCS 90 endorsement, and you show the limits that's met to the government. The MCS 90 is not coverage. It's involved only when there is no coverage. So you always look at coverage first. If there's coverage, then you never look at the certificates or the endorsement. So that's the end of Motor Carrier 1 and 2. We hope you understand now why the motor carrier is unique. That's because of the registration. The information provided in the registration, we talked about in 1, will tell us who they operate, will tell us what the application needs to include, tell us what the underwriter looks at. They also need, and this is where they get involved in insurance, this is where they need us involved in the insurance industry to meet the financial responsibility imposed by the government, either the limits required by the state or the financial responsibility required because they're hauling processed goods of others in interstate commerce, or because they're hauling any goods in interstate commerce. They will need the endorsement versus the 91X filing, and how they meet private carrier. We hope this gives you a better understanding of the insurance coverage you're providing and why you need to provide this when you're insuring your motor carriers. Thank you for listening to this process. And if you have this program, and if you have any questions, please send an email to trs@mcief.org, and we'll attempt to answer your questions.